In the world of investing, economic crashes are as inevitable as the setting sun. These cataclysms, often unpredictable and volatile, can turn the stock market into a wild beast, leaving investors in a state of panic and uncertainty. Fortunes are made and lost in the blink of an eye. To understand the full impact and implications, we need to delve into the annals of history and dissect some of the most impactful stock market crashes. The first significant crash in the 20th century was the Panic of 1907. An overambitious attempt to control the copper market by F. Augustus Heinze and Charles W. Morse set the stage for this economic disaster. They tried to corner the copper market, but their plan backfired spectacularly, leading to a severe banking crisis. Bank failures and plummeting stock prices sent shockwaves across the country. Trust in the banking system waned and a wave of panic ensued. People rushed to withdraw their money, causing further instability. This crisis exposed the vulnerability of a banking system without the safety net of a central bank. The fallout from the Panic of 1907 was significant, leading to the establishment of the Federal Reserve in 1913. This institution was designed to prevent such financial catastrophes in the future. The Panic of 1907 demonstrated the fragility of a banking system without a central bank. Fast forward to 1929, and the world witnessed a crash like no other: the Great Depression. Imagine, if you can, the Roaring Twenties, a time of economic prosperity, innovation, and above all, optimism. The stock market was the place to be, with everyone from tycoons to teachers trying to get a piece of the action. But this rampant speculation was a dangerous game. As the saying goes, what goes up must come down, and come down it did. On October 24, 1929, the stock market plunged into a free fall. This day, forever etched into history as Black Thursday, was the beginning of a catastrophic economic downturn that would last for a decade. The crash of 1929 was not just a financial crisis, it was a societal disaster. But what caused this unprecedented crash? The answer lies in the unchecked speculation that characterized the Roaring Twenties. Investors borrowed heavily to buy stocks, betting on the continued rise of the market. But when the bubble burst, they were left with massive debts and worthless shares. The banks, which had also invested heavily in the market, found themselves in a similar predicament. The effects of the crash were far-reaching and devastating. Unemployment skyrocketed, reaching a peak of 25% in the United States. Across the globe, people lost their jobs, their savings, and in many cases, their homes. This period, known as the Great Depression, was marked by widespread poverty and despair. But from the ashes of the crash, new policies emerged. Governments around the world recognized the need for stronger regulation of the financial sector and implemented measures to prevent such a disaster from happening again. The crash of 1929 changed the global economy and the way governments manage economic policy. In the end, the Great Depression was a harsh lesson in the dangers of unchecked speculation and the importance of sound economic policy. It's a reminder that while the lure of quick profits can be tempting, the consequences of reckless investing can be far more devastating. The crash of 1929 changed the global economy and the way governments manage economic policy. The crash of 1987, also known as Black Monday, was a wake-up call to the potential dangers of computerized trading. A day that will forever be etched in the annals of financial history. It took place on the 19th of October, when the Dow Jones Industrial Average plummeted by a whopping 22% in a single day. This was the largest one-day percentage drop ever recorded. So what led to this catastrophic event? The answer lies in a cocktail of factors, with computerized trading and international disputes sitting at the top of the list. Computers were the new kids on the trading block, executing trades at lightning speed. But they were also programmed to sell when prices fell, leading to a vicious cycle of selling that spiraled out of control. Simultaneously, international disputes concerning monetary policies and trade agreements were adding fuel to the fire. The tensions between the United States and its major trading partners were running high, and the markets were on edge. In the aftermath of Black Monday, regulators scrambled to put safety measures in place to prevent such a calamity from happening again. This led to the implementation of circuit breakers in the stock market, mechanisms designed to halt trading in the event of drastic price swings. Black Monday was a stark reminder that even in the age of technology, markets can still crash dramatically. It showed us that no matter how advanced our systems become, they are not immune to the unpredictable nature of human behavior and economic realities. The financial crisis of 2008 was a crash that shook the world and led to a global recession. This was no ordinary downturn. It was a storm that left virtually no corner of the globe untouched. But what caused this economic earthquake? The seeds of the crisis were sown in the housing market. Throughout the early 2000s, there was an unprecedented boom in property prices. This housing bubble was inflated by a heady mix of low interest rates, risky lending practices, and the belief that property prices would always go up. Mortgage lenders, eager for profit, started offering loans to those with poor credit histories, known as subprime borrowers. These risky mortgages were then packaged into complex financial products and sold to investors worldwide. But when the housing bubble burst, the value of these products plummeted. Banks and financial institutions found themselves holding assets worth far less than they had paid for them. This triggered a crisis of confidence in the banking sector that spread like wildfire across the globe. The effects of the 2008 crash were far-reaching and long-lasting. Millions of people lost their jobs, their homes, their savings. Countries from Iceland to Greece found themselves on the brink of bankruptcy. The global economy went into a deep recession, the likes of which hadn't been seen since the Great Depression of the 1930s. In response to the crisis, governments and regulators implemented stricter financial regulations. These aimed to prevent such a catastrophe from happening again by making the banking sector more transparent and less risky. But it was a hard lesson learned. The crisis exposed the dark side of the financial system: unchecked risk-taking, a lack of transparency, and a failure of regulation. It served as a stark reminder of the damage that can be done when greed and recklessness run rampant in the world of finance. The 2008 financial crisis showed us that unchecked risk-taking and lack of regulation can lead to catastrophic results. But it also showed us that we can learn from our mistakes and take steps to prevent such a disaster from happening again. Despite these crashes, the global economy has shown an incredible ability to bounce back. Like a phoenix, it has risen from the ashes time and time again, demonstrating an astounding resilience. Each crash has been followed by a recovery, and not just a return to previous levels, but often a surge to new heights. This continual growth of markets, despite setbacks, is a testament to the enduring strength of our global economic system. But it's not just about bouncing back. It's about learning, growing, and adapting. Each crash has provided invaluable lessons, prompting policy changes, regulatory reforms, and shifts in economic thinking. These lessons have allowed us to prevent future crashes, or at least mitigate their impact. Crashes might be part of the economic cycle, but each one teaches us a valuable lesson, strengthening our resilience and paving the way for a more robust and stable global economy.